All right.
All right, let's see here. Lane is the co-owner of MFPE Investments LLC, which controls 2,100 plus units, and where he is responsible for finding investment opportunities, analysis, and marketing. He has real-world experience in working as a project manager for over 230 million of capital construction projects. He feels compelled to inspire and mentor through his podcast at simplepassivecashflow.com. Lane, I'm going to have you go ahead and take the stage here, and for those of you who are watching, if you have questions for Lane, feel free to add them to the Q&A box, and we will answer a lot of those questions that you have towards the end. That way it gives him enough time to be able to go through this information that he has to present to you. So Lane, take it away.
Yeah, and thanks for having me, Dan. And hello, everybody. If you guys haven't checked out my podcast or know a little bit about me, I grew up in Hawaii, so I'm a little laid back. Some people don't like that, but that's just how I am. So if you guys have questions, type them into the Q&A box, and we'll kind of go over them as they come up. But yeah, I'm going to talk a little bit today about investing as an LP and why I think it's why I do it. I mean, I'm going to kind of go through some of the reasons why I made that decision for myself. So like I said, I grew up in Hawaii. It's very different from, I was in Seattle for 14 years, but it's a lot more community-based. And this is the way I have kind of created my investment club, and I have a local real estate club, realoha.com, which is the first passive investor group in Hawaii. I think a lot of us on this listening in know that most real estate clubs are just a bunch of fix and flippers as opposed to value add apartment investors like us. So my professional background, I graduated in 2007 with a BS in industrial engineering from University of Washington. Then I got a master's in civil engineering. I may look 18, but today I'm 33 years old, professional engineer. I started my career as a construction supervisor working for a railroad where I supervised a bunch of guys much older than my grandpa. And that was kind of where I cut my teeth in project management. I moved more into, I got tired of living on the road, and I moved over to a more desk job, project engineer, and worked for a city. So I understand kind of the permitting on that side as a city engineer, public projects. Did a year working for the airport, Department of Transportation, when I moved back to Hawaii. And the last job I had, I worked for a hospital. I thought it was going to be some kind of way I could get into assisted living investments. But like Dan said, I quit my job recently. I just couldn't take it anymore. And apparently these passive investments work. So I quit. So I'm an investor full time now. And today I'm in Houston. I've been on the road for the last couple of weeks, just checking out deals and, living the dream, just waking up, getting my Starbucks and going to checking out deals. So more importantly, my real estate resume, and I grew up in Hawaii. I had never thought about owning rental real estate, moved to Seattle for college. But shortly after graduation, 2007 to 2009, I just saved a bunch of money because I was on that linear path, like a lot of high-paid professionals. You're told to go to school, get a good job, got my engineering degree, worked hard, and then I just saved up to buy that primary residence and just kind of followed the dogma that I think all of us are told to do. And I bought an A-class rental in Seattle. It was $350,000. It rented for I think $2,200, and I was an accidental landlord. And if I just did the math, my mortgage was $1,600, and that created about $600 of beer money every month for a young 20-year-old. And at that point, I realized, wow, like I just need to do this again and again and again to get myself out of the rat race. Bought another rental in Seattle, but around 2012, we all know here, primary markets, you're just not going to find the cash flow to be able to sustain a positive cash flow. So at that point, I went out of state, started to get these turnkey rentals, which I thought were cool in the beginning. Bought them in Birmingham, Atlanta, Indianapolis, built my my track record up to 11 single family homes of buy and hold. A lot of these were sight unseen. I had a property manager. Even did some international farm investing recently. I was just in Belize just yesterday and checking that out. $6,000 of education. So I joined a lot of these groups, these education groups and mentorship groups and masterminds. And it really got me into a group of people who really knew what they were up to and got me around the right people, kind of what we were doing today. Um, you know, I'm an engineer, so I like these flow charts. And if you guys want, I'm sure you guys can read through this stuff later. But a lot of this is investing 101, where you know to invest in multifamily as a passive, you need money. This is real estate investing. If you don't have any money, you got a money problem. And I'm here to talk about real estate investing. A lot of it, and then if you have money, how much time do you have is the next question. And what kind of day job do you have? What kind of salary do you bring in there? Depends. Really helps you decide whether you are going to go in as a passive or general partner. Obviously, you guys kind of know a little bit about my background. I'm pretty much a typical high net worth, well, not really high net worth, but high paid professional. I didn't really start off with very much starting out. Started with an $80,000 salary 10 years ago and just kind of grew from there. But, net worth wise, I kind of started with zero. And here's just a whole bunch of things that I tried along the path, different stocks, mutual funds, some notes. And, I found that multifamily is one of the places to go. Today, this is kind of my last bio slide, just so you know kind of where I'm coming from. After I spent a whole bunch of money into education, well, again, I spent even more money and doubled down and joined more groups. But I started to create my own investor club. I called it Who Deal Pipeline Club. This slide is a little outdated. We are currently at $155 million in real estate, and I've raised over $13 million just within my group. I don't know why people trust me, but they do. But people just copy what I invest in. And I'm always looking to invest my money first. And if people want to follow, they can follow. But I currently have a portfolio of 2,600 units, 15 apartment buildings, 2 manufacturing housing developments, assisted living facility, and those are some of the locations that I'm investing in today. A lot of secondary and tertiary markets. Again, if you guys have any questions as we go along, feel free to put it into the Q&A box there. Want to give you some background on a deal that I did where I'm active. This is the 2-unit in Des Moines, Iowa. And I'm going to fly through these slides. The story is this $3 million property, your typical mom and pop investor that you buy from, where it's underpriced. They ran it meticulously, not a lot of deferred maintenance, and it was found via direct mailer as opposed to a broker, which I believe 80% of deals are found through brokers in the multifamily world. So this is sort of an anomaly. Seller was relocating across the country for retirement. So it was a good deal. Undervalued rents, everything you're looking for in a value add stabilized apartment. It was 90% occupied when we bought it. And here's some of the pictures of it. When you're starting, you see the yellow refrigerators. You can kind of see the quality of it. And then here are some of the after. It all looks great, but I'll be the first to tell you that I didn't really enjoy this experience. It was a lot of pain in the butt for me. And I kind of saw this experience as trading time for money. I mean, from my perspective, it was a lot easier to go to my day job and just sit on my butt and just turn out more widgets that I created on my computer than to take on the extra risk, put down the hard money, and take on the operational of this project. So that's just my perspective. And I believe the nice thing about multifamily is that everybody can do it, but from a business standpoint, that is also another reason why you should not do it too. Some of the reasons why I do like multifamily investing in general, but I'll kind of talk about my story on how I felt to be more of a limited partner and went down that road after that first property and a couple others where I'm more the direct operator, how I transitioned over. But just to kind of roll through these real quickly, historical stability. I'm sure you guys have kind of been beaten over the head with these kind of stats, but the middle class is not moving up. America is not moving in the right direction. The rich are getting richer and the poor are getting poorer. Therefore, the greater demand on workforce housing is just going up more and more. So, as an investor, you're always looking for these trends and trying to bet on the right side of the trend. Um, Looks like there's something flashing at me in the chat box. Oh, I think my microphone just fell out. Sorry about that. Another graphic I have here is you've got a lot of, just the age, a lot of people are growing into not getting the bigger houses these days, but, you got people growing into that starter home or the apartments in their career phase in the family formation stages. Also, America, the nice thing about America is our population is still growing, and a lot of that is immigration. And a lot of immigrants are just known to live in apartments when they first start out. And then you also have these trends of oversupply and undersupply. And I believe that workforce housing, Class B and C apartments are generally undersupplied across the country. Of course, every market is different. And you try and look for, when you find a property, you're looking for the comps in the 5 mile, 1 mile radius. But for the most part, as from a macro standpoint, multifamily apartments is a good place to put money in. But as more sophisticated mom and pop investors, we're trying to find a little bit better insider advantage and trying to cherry pick those better deals. In this country, less and less of us are owning homes. Part of this is to do in George Bush, when he went to presidency, they had the initiative that everyone's going to be a homeowner, and maybe that's not the case. Another interesting thing that I kind of follow is household formation. People aren't getting married; they are until later. So family formation is not kind of that's what's going to spur a lot of people to get single family home. And you combine with the fact that people don't have the jobs or incomes to afford the down payments, makes it that's just a double whammy there. So just a lot of things that kind of fall into why the B and C class apartments, I believe, are the great place to invest in. Here's a little graphic on, I've kind of broken up property classes in class A, B, C, D, and F. I personally like class B and C. Class A, those deals I see, they'll cash flow right away, but I just don't feel like they're going to do very well in a recession. I feel like that, they may cash flow 10%, but I mean, I think I look at it from like a per unit basis where, maybe the rents will be 1,400. I really see them slashing that to maybe 1,200 or 1,100 in times of trouble when people are losing their jobs, especially like the white collar workers. They're going to shift down to the B class, and then the B class will shift down to the C. Here's kind of the movements where I see in the next 5 to 20 years, the baby boomers will go to the C class, B class, and A class apartments, as opposed to getting their single family homes for mobility and other obvious reasons. The Gen X's will move up to
nicer apartments and single family homes. The Gen Ys will be moving up, and just this general moving up as people get older. The millennials are that big cohort coming in, and they're going to be going into the Class C houses and Class B apartments, and that's where I want to catch them as an investor. So you've got all this shuffling around. But what happens in the next recession, right? I mean, if not, all of us would just invest in Class A apartments all day long, collect the cash flow from the stabilized building, and that would be it. Why is it that we invest in Class B and C apartments is the what if. Like, we're trying to recession proof our portfolio. And this is how I see, there's this bell curve, and I believe the bell curve will shift more towards, the Bs will move to the Cs will move to the Ds. You'll have this cascading effect. And the millennials will move back home with their parents. That's kind of a joke. But second reason I like multifamily as a limited partner is the high yields. So this is the one investment out there. I think mobile home parks are very similar and self-storage is very similar, but it's like a hybrid investment. You get cash flow and appreciation. I mean, the appreciation is forced appreciation, so it's not like, it's just icing on top of the cake, like how I used to do turnkey some comps. Forced appreciation is you've worked the value in there, you've improved the property, so you improve the net operating income. But still, appreciation could not come, but you still have the cash flow there, and that's something you can vet before you even go into a deal, if that cash flow is there. And as someone who believes that recession is coming in the next 1 to 3 years, I'm trying to go into deals that are more cash flowing, higher cash flow, without bridge loans. That's just my philosophy and what I stay to, but not necessarily I'm going to, follow that to a T, but definitely with 80% of my portfolio, that's what I look at first, cash flow. Typical Class C LP returns. I think you used to see, the tagline, double your money in 5 years. Today, it's a little harder to really get that. You can fudge your numbers to get that, but I think you're usually seeing about 80 to 100% return in 5 years with a sale at the end. You're seeing prefs at a 5 to 10% rate with cash flow paid quarterly. And, this is usually with a business plan of $2,000 to $6,000 rehab per unit to get a 10 to 15% bump in rents. I would call that, it's a value add, but I would still call that a light to medium value add. You're $2,000 to $6,000. You're getting some paint, some new flooring, maybe some new countertops, but definitely just resurfacing a lot of the tile, or just, nice lipstick on a pig, some people call it. Forcing appreciation, like I said, it's not like single family homes. We actually have control over this. If we improve the net operating income, we have control over it, decreasing the expenses or increasing revenue. And whether you play with one of those two levers, you can increase the net operating income. And this is where it comes down to determining your property value. You take that net operating income, which is income minus expenses, and you divide that by the cap rate. And that cap rate is something that is different in every market, and you've really got to have your finger on the pulse to know what cap rate to use. So for example, if you were to just change out the property management, like a lot of these buildings will buy, like the property management are just a little lazy. They may know a lot of the tenants. They don't want to be the bad guy. But if you just cleaned house or you ordered the current property management to, hey, let's just start charging closer to market rents. So in this example, I take $45 bump in rents across the board, and say you had 100 units, you just created $4,500 a month of revenue per year. That's $54,000 a year. And let's just say it's like 8 cap in that market for that asset class. The 4,000 divided by 0.08. So you've just increased that value of that property by $675,000. Of course, you have to show that stabilized for a year or two on financials, but this is not market appreciation. This is forced appreciation. Another example too, maybe you can save on expenses instead of increasing the revenue. Another one that's popular is, instilling reserve parking at $100 a space, and maybe you just have 20 spaces. You do the same formula, and that could have created $300,000 bump in value. So you don't buy a property unless you can go down a list of all these ways to increase revenue or decrease expenses. So I think I want to show this example, just another example to kind of go through how these kind of deals kind of work, and the delta in the unit prices, how it increases the NOI, and then you divide the NOI divided by the cap rate. For a limited partner, understanding what assumptions are being used is very important. One of the biggest thing I have a lot of discussions with my investors about in my closed mastermind is this reversion cap rate, what is used. Now, the cap rate is what is the prevailing cap rate today. Like I said, it can range anywhere from 4 cap to an 8 cap. I would say probably maybe a Dallas might be a 5.5 cap today for a Class C asset. I might be wrong, plus or minus 1, but just to use that as an example, I want to use a reversion cap rate or an exit cap rate of 1% higher, because I want to be assuming that when you sell this asset in 5 years, that you're assuming for a softer market. And it's very counterintuitive, but when you play around with the numbers, you go, going back to this formula here, you might want to take a screenshot of this. This is, you start to play around with the cap rate, the capitalization rate, and you see how we divide it by 0.08 in this example. If you start playing around with that and you start to divide it by 0.09 or 0.1, you see the bump in value vastly decrease. So this is a way that you can really skew your numbers and use bad assumptions. The cap rate going up means more people are paying less income. This can work in your favor too. I mean, cap rates can go down, but as a limited partner, I just want to assume that we're selling it in a softer market, just to stress test the investment. I don't want to see a reversion cap rate of the same thing. I don't even want to see it increased by 0.5%. I think that's too slim of increase. Of course, a lot of deals are different. The business plan may be a huge value add where you're increasing the value so immensely that maybe it changes asset classes from a Class B plus to an A class rental. But those are sort of special cases, I believe. Every deal is different. Another reason why I didn't like to be the general partner or the key principal getting into these deals was you're getting the leverage in your name, the loan. And although we're getting, these nice terms and Fannie Mae, Freddie Mac sponsored prop loans, and a big component is that it's not, they can't come back and sort of collect. It's a loan where you can't you can't collect on it, and people think that it's very safe, but it's not ironclad. And I've been hearing a lot of articles where Fannie Mae and Freddie Mac will come back to the loan guarantors and trying to collect, or at least going into a lawsuit. I didn't want to be that person. I didn't want to get involved with that. And with being an LP, you're one more layer removed from this, and it doesn't go on your personal credit. And this really helps me. And I think a lot of other passive investors who've kind of quit their jobs, you don't have that W-2 income. So this is awesome because you don't need it anyway. And if you guys haven't heard of this trade line thing, it's kind of cool. You guys can, it's like a little hobby that I've developed, but you can get all those travel hacking credit cards, and you can put people on you can rent out your credit to other people. And I've made like $5,000 the last few months doing this. It's definitely a lot better than a turnkey rental where someone can trash the house. Let's put it that way. I mean, for each credit trade line that I put on as an authorized user, I usually make each time somebody does that. So it's pretty cool. And that's the kind of stuff I play around with now that I don't have to worry about what my credit score is. Because for commercial real estate, and especially as a limited partner, what your credit score really doesn't matter, whether you had a bankruptcy or anything like that. This is what I was kind of talking about before. You know, we talk a lot about how multifamily has non-recourse debt, but I was saying, you know, I don't, as an investor, I don't really want to be signing on the loan. I think in the beginning of my investing career, I was very into signing on debt and getting my key principal card, or people will call it the Fannie Mae card, so I can go and sponsor other deals as a loan guarantor. I just don't think it's a good risk reward for my money. Even if you were to get compensated with maybe 1% or 5% of the GP or whatever, I just don't think it's a good return on my money for the risk profile. And I think this is, for limited partners, that's kind of an afterthought. For limited partners, like, the recourse component, them coming back to limited partners, is a very small possibility of happening, as you're another layer removed from this. See a question here. Yeah, so a question here, are you solely investing passively? Yes. So my role is I find a team, and teams send me deals, and I analyze said deal, and I decide if I'm going to invest. And I really don't make any calls in terms of operation. Like, I don't want to be the person who is going to keep the property management. The property management, they run the day-to-day, but the asset manager, the operator role, is the person that manages the week to week. I don't want to be that person. I want to have a life. The whole reason why I signed up for this whole real estate investing thing was to have a life where I didn't have to work. I do sort of enjoy it sometimes, and it feels like, you have control of your own destiny, but I don't want that to be my full-time job. So I focus on just finding deals, spreading my capital over many, many deals. I hope that answered your question there. Let me know if you need you have a follow-up. So another reason why I invest as an LP is for the tax advantages with depreciation. So on the right there, that's an example of a K1 form, and that's pretty much all you get for everything you need. How much money we made and how much money are you able to write off or put into your passive loss column. Like I said, I had 11 of these single family homes put into a couple of LLCs, and it was a nightmare. I had to put on the Schedule E. I had all these spreadsheets and columns for all the, I think like 13 or 20 different line items for marketing, advertising, professional services, loans, rents, income, for all your single family homes as a mom and pop investor. And it was a nightmare. My life is so much easier these days with these K1s, and I just give it to my CPA, and it's simple. One of the just real estate in general, we all know that the property goes up in value, but on paper, the value goes down due to depreciation. With single family homes, they're depreciating over 27 years. So you take the value of the property. So for example, my first property, the $350,000 single family home in Seattle, the property in Seattle, the land value is very expensive. So 2/3 of the property of that value, the market value, was the land. So 1/3 was the actual property. So you take that property value divided by 27 years, and I could, it worked its way out to be about $8,000 I could deduct over 27 years as a single family home. But the awesome things about these multifamily deals that are big enough is you do this cost segregation, and you go out and you write off you're able to itemize all the little components of the property, and you're able to more aggressively write off these properties. Instead of over 27 years, I think the vast majority of it can be written off in the first 3 to 5 years. So I am not a CPA, but I mean, here's kind of, as the operator of that one deal, we were trying to work with some cost segregation guys, and just getting some estimates on some of our tax savings right there. That first property, that $3 million property with the cost basis of $2.6 million bucks, they figure they'd save us $130,000. Here's how it was kind of broken down here, highlighted in yellow. On the right side, that's what we would have been able to write off every year. And then on the left side, that's what, with bonus depreciation and the new aggressive tax write-off laws, what we were able to write off right away. I'm not going to get into too much of what a cost segregation is. If you guys want to learn more, go to my website, simplepassivecashflow.com/cost-seg, COSTSEG. And you guys can read all about that. But like I said, it breaks up the components of the building into itemized components, and then the CPA is able to more aggressively write off certain categories of those components. And that's what allows you, a lot of those components with the new tax laws, you're able to write off like 100% in the first year. And that's what's kind of coined the term bonus depreciation. Again, there's the comparison. If you would have done cost segregation and gotten bonus depreciation, or if you would have just done it like how everybody else does. Another reason why I do this is, like I said, I had 11 single family homes. I was, just to use this simple, rule of thumb of 10 single family homes, it's $3,000 a cash flow a month if you're just assuming $300 a month, which is cool, but nobody's going to retire from their job with $3,000 a cash flow a month. But with that, I was seeing about an eviction a year and 4 large issues that would happen from time to time, like a HVAC would go out, or a plumbing leak, or there'd be a rainstorm and water would run into the basement. And that's not a problem. 10 single family homes, that workload is very manageable. But when you start to get into like 30 single family homes, and at that point, you're starting to hit more serious cash flow, $6,000 to $9,000 cash flow a month. And that's when you can start to think about quitting your job. But look at the problem, not exponentially increase, but it linearly increases to 4 evictions a year, 12 large issues. And now you can see the writing on the wall, which is you just created yourself another job. And for a lot of my investors who are doctors making like $350,000 a year, it's just better if they just take a extra shift on the weekend and to take on the extra workload and to write an email and call up the plumber or whatever like that. It's all about, doing your highest and best use. And then, you know, like I said before, when you're doing all your single family homes, you're doing your Schedule E's and all these itemized properties. But with the K1s from each individual deal, you just get a bunch of these K1s. It's very manageable, and you don't really need to think through them. You just give it to your CPA. It's very simple. I mean, in fact, it makes their life a lot easier. The seventh thing was the economies of scale. You know, with these apartment complexes, you get the property management that lives on site, and they take care of all the day-to-day issues. And then the asset manager, one of the partners in the deal, who I kind of call the operator, keeps them accountable as more of a week-to-week basis. But as an LP, you are sort of insulated from that. But it's not like, you know, with the single family homes, when you're a mom and pop investor and you're working with your property manager, you're not a partner with that property manager. A lot of times your outcomes and the way you're compensated or they're compensated is not aligned with your goals. But in this arrangement where you're the LP, you have a operator partner, you know, the PPM should align you in the same direction where the property's performance should be aligned with the goals of what you want, which is to create more money and what they want. Because a lot of time the operator is I mean, as a single family home investor from the start, you know, you got keeping people on staff, prepare people. And personally, I just didn't really like doing that. I mean, I did that at my day job, and it just got to be really tedious. It's like adult daycare. And maybe that's just why I stopped working, but I just didn't like to do that stuff. Oh, kicked out. Let me put it back on. For me, it was just about creating passive income, and I didn't want to really deal with that. Um, as an LP investor, you're part of all the economies of scale, bulk materials, insurance, getting better quality providers. I saw this on a walk the other day, you know, with these single family home operators or these smaller apartments. Like they're getting these kinds of smaller outfits to come out. Like, you know, with these larger apartments, you're just getting bigger and bigger outfits. You know, they're actually getting real insurance. You know, they're more institutionalized vendors you're working with and higher quality. And as LP, you don't have to worry about any of the tenants' toilets and trash and any of the landlord burnout, which I'll tell you is pretty real. I mean, right now, last year I sold 7 of my 11 properties. This year I'm selling the remaining 4. This past week I'm working on somebody got evicted a month ago and they trashed the property, and my property management company and my contractors are giving me like a $60,000 bill to get it back up to be able to sell. And that is not fun. And as much as a cash call in a partnership, not fun, but I feel like with syndications and private placements and being an LP in these larger deals, I mean, it just kind of smooths out the bumps in the road. Where I'm having to come out of pocket $60,000 to maybe not lose 20 grand on this property that I've owned for 3 or 4 years. It cash flow great in the meantime, but you know, the profits from that cash flow were only about like, you know, 5 to 10 grand. And obviously I'm giving that up right away, just with a one big repair. One caveat, I think a lot of people will call me and they'll say, you know, they'll look at the slide and they'll understand, yeah, I don't want to worry about the single family homes. I want to, you know, I want more roofs. because if I have some vacancies, it's not like I'm losing everything or not making any money. But I'll still be the one guy who'll say, if you're starting out, your net worth is under 500,000 or $250,000 net worth, I would say start off with single family homes on your own, because I believe it's a prerequisite to gain the knowledge to be able to join as a limited partner in the future. So a lot of these things that we're talking about and going over, you have a true understanding of what are the risks and rewards, as opposed to just sort of reading a PDF on the deal. On these bigger deals, I mean, here's kind of a risk matrix on how I look a lot of things and on my higher level investing. I believe syndications is a lot lower risk, but it's like a roulette table where, on the roulette table, you have the house advantage card, or sometimes it's like a double diamond or the green zero, or if you land on there, that's the house advantage. They just take the money. And it's no secret that there are from time to time people who will embezzle money and not be the most uphold their end of the private placement. It's sort of the dark side of this real estate game. And one thing that is nice is it's a very small community. So a lot of us know each other and hear things that happen like that. But it's not like there's a website, so-and-so embezzled money. This is a private placement world. A lot of the stuff that happens is kind of nobody ever hears about it. So to recap, I believe the risk is a lot less, but there is that possibility that you sort of, lose your investment. But that's why as a investor, you're not putting all your chips on one deal. Most of my investors, I tell them, don't put any more than 5% of your net worth into any one deal. Again, in this risk matrix, you would kind of categorize as a shady character as something that's extremely improbable. Not to say that it can't happen, but the severity can be catastrophic. But when you compare it with like single family homes, I've had this property that's $60,000 of rehab. I had another property where it's $20,000 of rehab. So let's just say you do invest with a shady character in a private placement. Well, worst that can happen is you just lose whatever you put in. So you invested 50 grand. It's not like it's a very, 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 very low probability that somebody's going to come after you and say, you're going to lose your 50 grand, but oh, by the way, you need to put in another 50. But single family homes, or when you're the direct operator, now you open yourself up to another level of catastrophic damages. So although it's extremely remote, it can be very catastrophic or hazardous. And where I see, obviously we don't want to lose our money, but I think for a lot of high net worth individuals, it's more about capital preservation. Let's firewall our investments. So even if we lose the $50,000, you don't lose any more than that. And I think that's what's nice about being an LP in a lot of deals is you've got the upside, but you're sort of hedging yourself on the downside that you don't fall too far. From a high level, wealth creation, Kiyosaki, I think, said it best in Cash Flow Quadrant. He showed the employed folks. Obviously, we're all drinking the Kool-Aid. We don't want to be those guys. And then, a lot of us are sort of self-employed. But I think where we kind of go astray is, a lot of us get into this business, buy rentals, maybe get a small apartment complex, but we start creating a self-employment or business when really we started on this journey to be investors. And by being an LP investor and investing in many deals, that's how you become an investor. But somewhere along the way, I see so many of my friends and myself included for a couple of years, had this thought that I was going to be an operator and create a business for myself, which wasn't, that was not the goal. I had kind of lost sight of that. Here's an article that, it's just, you don't really read these kind of articles in like the mainstream, but private placements and these country club deals that we talk about a lot as sort of second nature is not what many people even know about. But this is what the high net worth folks out there are doing. This was a kind of interesting study that I found where they kind of figured out, what are people of high net worth people? You have the net worth tiers on the left side. How if you were to break up all their assets, and it's mostly that the blue colored stuff, which are business interests, which I would call directly, most times a private placement in an apartment deal or a new business. And maybe they see that real estate is actually a smaller portion, but we don't know if those business interests are private placements in apartment deals or mobile home parks or whatever. But you definitely see what the people who are $1 million or less doing. Obviously, not what you want to be doing. So I'll take you guys back to 2016 when I was, I thought I was going to be an apartment investor, because I thought I was, I was going on this linear path again, getting single family homes, got 11 of them. And I think I was only like 29 at the time. And I was like, all right, I'm going to be doing this real estate investing thing for quite a while. Yeah, probably should do apartments, right? Because that's like the next logical step, which isn't necessarily the thing to do sometimes. But I joined up. I got a mentor, finally paid for it. And I went into this and I thought that, hey, I was going to be the guy who would find these deals, do the syndication, run it. It'd be great. And I'd make all this money and I quit my job finally. But then what I realized was, first of all, there wasn't any deals out there. When you actually learn how to analyze the deals, you realize how little few deals are out there. It's also a great way to just learn how to analyze deals. But I analyzed probably about 100, 200 deals in like an 18-month period. And what I realized was you're not getting the deals unless you're taking these brokers out to lunch like every other month and you're getting FaceTime, because there's countless other apartment investors kind of doing the same thing, just hitting people up on the phone or via email. And most of my peers who have kind of cracked the code, I mean, it took them like 18 months to 2 or 3 years to find their first deal. Assuming it's a good deal, right? I mean, you can find a deal next week if you pick a junk deal. But that was something I had sort of a epiphany there. Like I was like, well, this is kind of, I don't enjoy doing this, right? And I think you need to begin with the end in mind and think, what do you want to be doing with your life if money was no issue? And so I started to kind of thinking about this. And then at the time, 18 months in, me and my partner, we weren't getting anywhere because we were just a bunch of dudes who had a 20 unit and 11 single family homes. There was no we took the advice of our mentors and we went into deals as passives. We didn't have too much money. So we were very cautious on how we put in 50 grand here, 50 grand there. We increased our combined portfolio to 300 units. Pretty dang respectful, I thought, at that time to, go to brokers and now, hey, these guys, they look like they have experience on paper. And I did that. And then I just started to realize like, hey, putting money into these deals as LP is pretty easy. And at the end of the day, that was my goal, right? I mean, like I said, I live in Hawaii. We all drive like Corollas and Camrys. Houses are $1 million for a starter home, but life's pretty simple out there. And that was kind of the lifestyle I wanted to create. And I always talk to people about figuring out what you want and backwards engineering how much money that costs per month and defining that as your goal. And sometimes that takes a lot of like drunken nights with wine and, you know, brainstorming, but that is a key component. I think people, I hear a lot of guys like, oh, I want to get 1,000 units or 2,000 units. I think those are horrible goals because it has nothing to do with what kind of lifestyle you're creating. I mean, that's the end. That's the goal. So again, like, figure out what that monthly goal. And for me, it was like 10,000 to 20,000 a month. I'm not quite there where I want to be, but I'm on the track there. And that was what I realized at the time. And I was like, why would I want to be an operating partner who has to do all this hard work to find the deal, to keep these $20 employees accountable, something I don't like to do, like I said. And I want to just diversify over a lot of deals anyway. And so that was where I realized that I should just sort of just stay on the LP side. And what I realized, I did some self-reflecting on myself. And the reason why I did the general partner side for a bit was it was sort of just ego. I asked myself, well, why am I doing this? I'm just, well, I just want to sound cool. I want to be the guy. And that was not aligned with my end goal of, you know, just wanting to be financially free and just wanting to do what I want to do. So I asked a lot of people the same question. You know, I still have calls with people, free calls, you know, people who like listen to my podcasts. I'm always kind of looking to kind of connect with them. And, you know, for people who want to be operators or people in general, I always ask them this 2-part question. And the first question is like, first, are you good at being a landlord? And that includes, are you good at managing tenants, managing contractors, deal analysis, deal hunting, broker networking? And do you enjoy doing it? Do you like doing it? Now, a lot of my friends, they have kind of graduated, you know, from turnkey rentals to doing those burrs, which I think is a big risk reward issue, but they enjoy doing it. I think, and again, I always kind of fire back that first question is kind of a loaded question because ego-wise, you don't know if you're good at everything, so they're bomb at it anyway. So that is, you know, if you answer yes to both of them, well, congratulations. You can be a Class B and C operator and deal with all this nonsense that happens all the time. I didn't want to be a mom and pop investor. You know, they do it themselves. They're not sophisticated and they don't trust anybody. And why I really like them is because in a lot of the deals I go into, they sell to sophisticated investors like me. And in 2016, I stopped wanting to be a mom and pop investor. I just sort of, I always just write articles and, you know, I just cut and paste this in here if you guys want to read this later. But this is kind of another snapshot on what I was kind of talking about. Basically, it was a way to minimize PAITA, or it's the acronym for pain in the A. It's kind of just like this is like a page I just ran of all like the pain in the butt things that I do as a landlord and stuff I don't like to do. So this is one of my most popular slides. This is the ideal. If you had $500,000 and you need to invest in, here's the way I would recommend doing it. Get some of these turnkey rentals. They're kind of a pain, but it's a great way to start on a smaller scale than to bring in the syndications and to kind of build your portfolio with cash flow first. And then once you got cash flow, now you start to play around with some more higher risk, higher return stuff. I have this other idea of this opportunity fund that I play around, not the opportunity zone fund, but it's just a way I pair liquid investments, private money lending, and infinite banking. You guys can check that out, simplepassivecashflow.com/OFund. But you know, here's a Sankey diagram of my progression throughout the years. I mean, this investing thing is not a get rich quick thing, but it's a get rich slowly thing or surely thing. So you're just picking up these rentals or from in the beginning, and then sort of halfway, 5-6 years, now you're putting in those syndication deals, and you're getting a lot more passive, and now you're starting to sell off a lot of those single family homes and get to be more passive. And here's sort of the progression. You've got a good job, turnkey rentals, now of this SPC 2.0 where I'm transitioning to syndications. But I ultimately think that, the simple passive cash flow, the hard part is figuring out what you're going to do when you're all passive. I just quit my job two months ago. I'm still trying to figure out what the heck I'm going to do with my time. I just kind of write on my website all the time and podcasts, but I need to find some hobbies, to be honest. Most of us who are having good jobs, you're going to be probably financially free in 4 to 7 years. So like I said, begin with the end in mind. Life's kind of short. There is a whole bunch of ways to invest, and multifamily value add is just one of those ways. But I think it's an awesome place to start. And if you're always trying to get to the more exotic thing, this is one step in the progression. Any questions before we head off? You guys can type into the chat room. One question I get a lot is, when do I go from single family homes to syndications as a passive? I created this little chart. I think it's a Google file that I think you guys can download. But I made this little graph. I mean, it's sort of a combination. On the y-axis, the left side is how much liquidity or net worth you have, and on the bottom is how much money you're able to save every year. I think that's sort of a loose threshold, and if you're below that, just keep working as being a GP or picking up small single family home to get your portfolio up to a certain critical mass. But if you're above that line, you definitely need to be thinking about being more passive. One question here: what do you look for in your operating partners? What makes them good, bad, in your opinion? So I have a two-part test. First is people, second is numbers. So the second number is the easy part. You got to learn how to analyze the deals yourself. You got to download one of these analyzers out there, and you got to learn what assumptions to use, so that when you get pitched a deal, you analyze the numbers yourself. Of course, easier said than done. I paid $30,000 for someone to teach me how to do this, but that's important because numbers don't lie. People do. The second part of this is the people. And I don't work with people I don't know, like, or trust. People send me deals all the time, and the first question out of my mouth is like, who the heck is this guy, right? Who do you know? And this is why I feel like one of the biggest things as passive investors is to grow your network and to create a network around these people, and they're giving unsolicited advice, and you're just, hey man, what have you been investing in this past year? Whose deals have you been going into? Here's some I've been trying. This one's been pretty good. I think that is very critical to a limited partners progression. So that's why I've kind of created this Hui Deal Pipeline Club. I run a mastermind. There's about 45 of us in there. We kind of talk amongst ourselves, and we kind of just, it's not just investing in multifamily deals, other asset classes, but for the most part, it's nice to talk to another accredited investors and kind of open up the kimono and build a relationship. And that's been one of the coolest things for me making this podcast, is like, I get really cool people calling me. I also get a lot of weirdos calling me too, but I kind of stay in touch with the cool people, and a lot of these people have become my good friends. And it's kind of lonely being a real estate investor. I mean, I feel like Thanksgiving is kind of a lonely time. I mean, that's when the investors got to go hang out with their families, and nobody wants to talk to me about investing in that time of the year. But yeah, it's kind of cool when you get like-minded people together.
Awesome. So, were you able to answer a few of these questions that were on here, or are we going to go ahead and answer them now?
I got a few, I got them all done.
Good. So if you guys have any further questions for Lane, feel free to add them in there. And thank you so much for the information you provided as well. And you're going to be coming through soon and doing a tour, aren't you, on some of your properties?
Yeah, I mean, I'm still helping out a lot of guys get single family homes.
Like turnkey rentals, or
yeah. I mean, I think it's more like just check. For when I first got started, it was just such a reach to go out to a lot of these places like Atlanta or Birmingham, and it's so different from out in California or if you're out in Boston. I mean, sometimes it feels like going backwards 20 or 30 years. And I think what a lot of times investors will go out there and they'll realize like, hey, this isn't that bad. This is actually kind of nice. I actually kind of like to live in this area, especially with these prices, that's for sure. But I think that getting out there and actually visiting the properties or visiting the areas is one of the biggest things that you can do in the start. After you've done it a few times, you don't need to do it very much often. I mean, who wants to go to Birmingham? It's kind of a boring place, but I think it's a critical checkbox that most investors have to do.
And always feel free to go to the simplepassivecashflow.com and start to follow Lane. He's got a great podcast. I really enjoy listening to the podcast as well as to your session every time. This is the second time you've been here, our second summit, and you went to the first one and this one and spoke at it and had a lot of good comments from the first one as well as with this one already. And thank you so much, Lane, for joining us here today.
Yeah. We'll talk to you later, Dan. Hopefully see you next month in Dallas.
Yep, I'll be there, so we'll definitely connect up.
All right. Take care, man.
Thank you. Bye.